Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 53. The first half of 2022 is over, if you can believe it. It's been a brutal one for the stock market. I'll have all the numbers, share with you just how painful it has been. But we'll also take a chance to think about ourselves, think about your first half of 2022, and how you can make sure you have a strong finish to the year. Look forward to discussing all of these with you on the other side. So get your mind right. And let's get to work.
You dropped this.
All right. Well, it's great to be back with you this week. The first half of 2022 is already over. It's 4th of July weekend, so I hope you all have a great 4th of July. Take some time to celebrate the first half of the year. It has been a brutal first half of the year for the stock market, which we will get into. I'm excited to be here kind of live this weekend. I'm recording this the day before it releases. So the last couple I've been traveling, spending some time with my family, doing some fun summer stuff. And so a lot of the past couple episodes have been pre-recorded. So I'm excited to do this one live so we can go over real numbers, talk real strategy on the stock market and how it can kind of impact your, hopefully your future portfolio or the one you're working to build. And so a couple things, just some housekeeping things. There were some questions that came in last week's episode on investing $100 a month. That I wanted to clarify. Some people were asking me about partial shares. And so there are some institutions that will allow you to buy partial shares of stock. So you don't necessarily have to wait for an expensive stock like Google or that's about to split. You don't have to wait for it to split. You can buy partial shares. Some of them, they'll allow you to buy the partial shares on your phone, but they won't allow you to do it from the desktop, which is, they're trying to compete with Robinhood. So the reason I didn't bring it up in that episode is because I don't really, off the top of my head, I don't know who offers partial shares and who doesn't. So that is something that you can keep in mind. And, every time I record these, it's like, it's any conversation you have, right? You think of things you wish you would have said. And I thought you'd find it interesting that, the market isn't doing well. We'll get to that in just a minute. It's the worst start to the year for the stock market, or the worst first half of the stock market since 1970. But, I remember 2008, 2009 very clearly with the financial crisis. I don't think this is anywhere near what that was. But I got real aggressive with investing back then, and I did it on $100 a month. And I bring that up because I forgot to say that I still have, I've had that $100 a month going into my investment account since then. Now, of course, I do save more now, but I've never, ever turned that off. So I still have that automatically going into my investment account every single month, and just kind of a reminder that I can always hopefully be saving a little bit more. So it does work. It does impact your portfolio more than you think it is. It will. And it's more about creating the habit than it is about saving the money or investing the money. It's creating the habit. And so when you create the habit and you start making more money, you will naturally start to invest more. It's just the way that it works. So like when I'm working with students or whomever, I'm like, hey, just start with $50 a month. Start with whatever you can, because later on you'll add to it. So all right. So market news here. Worst start to the year, worst first half, I guess I should say, since 1970. So it's actually the fourth worst first half of the year ever. The worst was 1932, which the market was down 45.4%. So I say that because it could be worse. 1962, the market was down 23.5%. And then in 1970, the first half of the year, the market was down 21%, and we were down 20.6%. Now, again, just as a reminder, when I say the market's down 20.6%, that refers to the S&P 500. So that's the 500 largest companies. But when you look international too, the MSCI, also a really bad start for them. Their index having a very bad start. And so it's really just kind of a global, a bad market for the entire globe, right? So you have inflation everywhere. You have the Ukraine crisis not going away. I mean, there's a lot of bad news. When you talk to anybody, nobody wants to talk about the stock market. Nobody does. It's painful. We're all losing money. Where I'm at, it's 106 degrees outside. So you're hot, you're losing money, and it's like, what, it's just not fun. And it's okay that it's not fun. And, you're going to see all these news stories. They talk about a bear market, which we're in. We've discussed that in the past. You talk about how long they last, all that kind of stuff. But when you have these kind of mental thoughts, when you're thinking about how bad the market is, I always remind myself to invert, right? So think about the problem from a different angle. So when I see that it's, most bear markets last 10 months or whatever the number is, you see a different definitions based on how they measure it. But let's say it's 10 months, let's say it's a year. I always look at that. I look at that as, okay, how many shares can I accumulate in the next year? How aggressive can I be with my savings, my investing? How can I accumulate as many shares as possible before it turns around and starts to get better? And a lot of investors want to catch the bottom, which is going to be hard to do. But when you look at some of these stocks, I mean, some of them are down. I think Amazon's down 37% already, right? So most of the companies, if there are companies that you are interested in, they are going to be down a lot. And so you're already going to get a deal on them. And I remember after 2008, 2009, I mean, stocks got incredibly cheap and you just had to start picking something, right? You weren't going to pick the absolute bottom, but you were going to, if you're willing to hold it for 3 years, there's probably something that you're going to be really happy. And so I'll share a couple ideas with you on that here in a little bit. But invert the problem and look at a way that you can make it, to your advantage. Most of the people who listen to this are younger investors in 2008, 2009. I guess I would have been 27, 28, maybe a little bit. Yeah, somewhere around there. But man, I mean, that was like a great time to start investing. And of course, you don't know what the future holds, but your odds of having a good track record now is definitely on your side. So a couple of things that are going into this. Number one is inflation, obviously. But the other thing is crypto is really hurting as well, right? Crypto is, it is causing pain everywhere. And so at the start of the year, the entire cryptocurrency market was worth $3 trillion. And now it's already hovering around $1 trillion, right? And so you're seeing these companies they're preventing people from being able to withdraw their money. You have ones that are basically being bought out. You have others that are going to go bankrupt. And it's going to get pretty nasty, I think it'll get nastier before it gets better. But there are some of these companies like Celsius is one. They haven't allowed people to take withdrawals. For whoever is listening to this, one of the things you have to think about, and one of the things that most investors take for granted, is that we all take liquidity for granted. And what I mean by that is we always assume that whatever we buy, we'll be able to sell it, that there will always be somebody there to buy it. But the truth of the matter is it's called the stock market. It's a market, which means if you're buying a share of stock, somebody has to be selling it to you. If you're selling a share of stock, somebody has to buy it from you. So when you have everybody trying to liquidate their cryptocurrency at once and they just want off the boat, there has to be somebody there to buy it. And when there's nobody there to buy it, these companies are just getting these massive drawdowns. And quite frankly, they don't have the cash to be able to make it happen. So it gets real scary real quick. People lose real money. Every day I read a story about somebody who lost their life savings, has lost a ton of money, and it's horribly sad, but it's not, that is going to continue. And so, as listeners of this podcast, you've heard me say over and over again, invest in companies that pay a dividend, that do a buyback, that pay you to wait for things to get better. Right? They're going to pay you for the market to get better, for the economy to get better, for us to kind of work these things out. And that's the problem with assets that don't have anything that back them. And that's really like cryptocurrency and NFTs and all this. There's no underlying company. They're not selling a product. They're not doing anything that really creates value. And that is a really rough place to be. Now, I say that because, there's reports coming out where a lot of investors that were involved in cryptocurrency used leverage. And if you'll remember, leverage is a fancy term for borrowing. They borrowed money to buy crypto or whatever. And so when they start getting margin calls, they have to sell maybe assets from another area of their life, which could be the stock market or whatever, to cover the losses. And so I think some of the drawdown in stocks can be attributed to maybe somebody covering their crypto losses. Like it does bleed over into other industries. And so this is when people really get hurt. And so when you see, companies or big time, hedge funds or whomever going bankrupt, losing a lot of money, normally leverage is involved. And that can become really painful really quickly. It's wonderful when the market's going great, but man, is it a special kind of awful when the market is going down. So kind of a lesson to be learned by many. And then even though I know many of you might not trade on margin, you're not borrowing to invest. I hope you're not. Just another thing to keep in mind with interest rates going up, right? The Federal Reserve raised interest rates 0.75% last month. They're probably going to do it the same this July. They're trying to slow down the economy, bring inflation down. But when they raise those interest rates, that means that banks are able to raise their interest rates as well. So there's been some reports that credit cards have, raised their interest rates because the annual percentage yield that they charge you, that fluctuates based on interest rates. So be careful of the credit cards that you have and make sure that you look, because they can change the interest rate on you. It's not something that has to stay fixed unless you have like maybe a special card, but normally that's going to fluctuate. So make sure that you check your cards, because in all likelihood your rate is going to go up. And there was a report that most of them are kind of at 20% interest right now, whereas in 2019 the average was 14.8. So that's going to be painful for some people as well, because they're not going to realize that they're paying so much in interest. And when it comes to the Federal Reserve and their ability to raise rates to slow the economy, you have to realize that they have a better brake. It can really, if you're thinking about driving a car, you hope that they don't slam on the brakes so bad that the economy that we just go through the windshield. Right. So that's why you see so many reports talking about, are we going to have a hard landing? Are we going to have a soft landing? Blah, 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 blah. That's what they're discussing. That's what that discussion is about. And so you have to protect yourself. You got to be proactive in your financial world and make sure that you're not kind of setting yourself up to get dinged. So make sure you keep that in mind as you're kind of going about your business. So, it's all about making sure that you're protecting yourself, because nobody else is going to do that for you. I also want to remind you of one financial bias, or, a bias that we have, that investors have, and that is projection bias. We talked about it episodes and episodes ago, but I want to remind you. So projection bias is when you take what's happening today and you project it into the future. So, for example, when the market's at all-time highs, everybody says, oh, the market is just going to keep going up. I'm going to pile in as much as I possibly can. Like, it doesn't do anything but go up. Trees grow to the sky. Well, it also happens when the market is negative, like it is today, where all of a sudden oh my gosh, the stock market's going to be terrible forever. I got to get my money out as fast as possible. It's just going to be awful for forever. And so when you listen to financial news today, I mean, there's a lot of negativity out there, a lot of negativity. And so again, think about the other side of that and say, I look at it and go, okay, well, if we get a little bit of good news, if inflation comes down a little bit, the stock market is always forward looking. So if it looks like inflation is coming down, the stock market is going to react to that. And so you got to get ahead of it. And this is how so many investors miss the bottom, because if you wait for the clouds to clear, it's too late. And the other thing that I want you to be aware of is all this recession talk. There's not somebody it's not Paul Revere where somebody comes out with a bell and goes, ding, 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 ding. We're in a recession, everybody. Watch out. We're in a recession. It's actually, they do it previously. So that they would say, like, when the numbers come out later on, they'll say, okay, on January 25th of 2022, we entered a recession. But when they say that, it could be December of this year, right? It's always retroactive. So don't expect somebody to come out and make a big, deal on it. They do it retroactively. And so when they talk about a bear market, it's in the beginning where it happened, but they do it retroactively. So you're already in it before you even realize it. So this is, a time where you got to, put your head down, think about what you're doing, and don't worry about all the noise that's going on. So when I look at my portfolio, my personal portfolio, yeah, it's not looking great, but all I'm looking at is how many shares can I buy, right? Accumulating more and more and more shares. I'm not really concerned with the overall number. I'm looking for good, solid companies that I can own, like we discuss on so many episodes. And I just have my head down and that's what I'm working towards, right? And that is the one thing I can control. I can't control whether the companies go up or down this week, next week, a month from now, whatever. But I can control if I'm putting money in, investing, buying more shares in good, solid companies that will pay me to wait, pay for the market to recover. And that's what I control. So that's what I worry about, right? And that's what you have to think about. You have to control the controllables. Otherwise, if you're listening to the news and all that, you just won't do anything. Right? I mean, who would want to? I mean, it's just awful out there. So you got to control what you can control, and that includes your thoughts. And so as we look at this first half of the year, this is a good weekend. Well, maybe not this weekend. You might be having too much fun, but this is a good time to think about, how is your first half of the year gone? It goes quick. I mean, just the other day, we were recording the episode on what people's goals were for the year. And I'll try to catch up with them. We'll see how they're doing this first half. But that seems like that was not that long ago, right? But we're already halfway through the year. So when you look at, what were your goals? Have you read the books you wanted to read? Have you done the workouts you wanted to do? Have you saved the money you've wanted to save? Have you become more valuable? Have you invested as much as you wanted to invest, right? This is a good time to take a self-assessment and think about, okay, how have I done the first half of the year, and what can I do the second half of the year? If you have some things that haven't gone your way, this is a good time to think about, okay, was that something that was out of your control? Was it in your control? Is there an adjustment you can make? Did you maybe, bite off more than you can chew, so to speak? We talk about how we always overestimate what we can do in a year and underestimate what we can do in 5 years. Right. But this is just sit down and just take an assessment. You don't have to share it with anybody, but think about, okay, this is how the first half of my year went. Be conscious of it, be reflective, and then think about, okay, what can I do to make the second half of my year better? Have you spent some time with your friends? Have you spent some time with your family? Have you gone on that trip? Have you booked that airfare? Boy, that's gone up. And I'm definitely glad I'm not traveling this weekend when you look at that, or the flights anyways. But, think about like the things that you had as goals for yourself. what can you do to make the second half of your year better and more effective and just to kind of keep you on track, right? So just kind of take some time and reflect and think about where you are and where you're going and be conscious of it, right? Live in the moment and be conscious of kind of where you're at and where you want to go. So I want to end this episode by talking to you about some of the stocks that I'm looking at, some of the investments. Again, I'm not your financial advisor. This is for entertainment purposes only, so please consult your financial advisor before making any investment decisions. But I like to, from time to time, just talk about some of the companies that I'm researching. Obviously, I discussed some of the big ones, Apple, Amazon, Google, the main ones that we all know that I think are easier for people who are learning about investments to kind of relate to. But I also want to, from time to time, just discuss some. So one I mentioned a while ago was Plains All American Pipeline. I think it's still around $10, pays a good dividend. It's an oil company, but not an oil company. Well, I mean, it's in the oil business, but it's not impacted as much by the fluctuating oil and gas prices. But one that I'm looking at that I found very interesting, I'm doing a lot of research on, is Palantir Technologies. And the symbol on this is PLTR. PLTR. And so go look at, watch some YouTube videos. There's some really good interviews lately with one of the CEO, Alex Karp, and Palantir. So one of the things they do, and just to give you some history on this company, if you go read the book, The Founders, which is the story of PayPal and how they were built up, right? That's Elon Musk, that's Peter Thiel, all those, they make their money in PayPal. And then 9/11 happens, and Peter Thiel uses the technology that they used in PayPal. So one of the biggest problems when they started PayPal was the fact that there was a lot of fraud going on, and people were they were losing $10 million a month to people basically stealing from them. And so they had to figure that out. They were like, okay, we are not going to have a company if we cannot figure this out. They put all their engineers on it. And so they end up figuring it out. Well, they start using, Peter Thiel uses that software. He kind of brings it over to Palantir. They kind of rework it. But Palantir, one of the biggest problems that many companies have today is that everybody's collecting your data, right? So, I mean, you go to Target, you go anywhere, you use your iPhone, whatever. People are tracking your data all the time. So they have all this data, but then what do you do with it? How do you figure out what the trends are in it? How do you figure out what's going on? How does a company figure out how to use that data? And that's where Palantir comes into play. So when they first came about, they started helping the government track things, right? There's some reports, they can't confirm or deny, that they helped find Osama bin Laden, that they helped prevent a lot of things because they have the ability to use that data to be able to kind of predict things that are going to happen, look at terrorist networks, how they're using their financing, all these things. Okay, so they have some government contracts based on that. Now, I like the fact that they have these government contracts because it allows them to have recurring revenue, right? So number one, that we talk about, number one thing to know about a company is how do they make money? So the fact that Palantir has government contracts allows me as an investor to feel a little bit better because I know, okay, they have these contracts with the government that's going to be guaranteed income into the company that they can use to build and develop their company. So they start off doing that, and then all of a sudden now they come out with a corporate product, right, that they can sell to corporations. One of the ones that's well known is JP Morgan. When you start looking at for JP Morgan to try to prevent fraud and mortgages and things that most people are not going to be able to pick up on, that their software can pick up on. And so slowly they start building up the corporate side. So they use the guaranteed money from the government side, and then that allows them to be able to kind of have patience in the business to develop, to be able to build up the corporate side of the sales. So they have products on both sides. And so I kind of like that mix. Now, they went public in 2020, and the stock has gone from, it hit a high of 35, maybe 40? No, 35. So it came public at $10, spiked up to $40, and now it's all the way back down to $9.27. So I'm kind of interested again This past year, it's gone from 28 last September to 9. So it's absolutely been beat up. But I look at this long term, and so what are some of the negatives? Well, one of the negatives is that, like a lot of Silicon Valley companies, they issued a lot of stock to pay employees. So that's kind of one of the downsides of Silicon Valley tech companies when they don't really want to pay as much. Part of the compensation package for engineers is they say, hey, come work here. We'll give you a bunch of stock, and it allows them to be able to pay them less. Now, it's okay when the market's doing well, but when the market's not well, it doesn't work out near as well. And so, for instance, there's a story out on Netflix that, if you started working at Netflix the last 5 years, you're down on your stock options. So that's one of the main issues with Palantir, but it is, I think that's more of a short-term problem. But I look at this and think that this could be one that you could go look at, just start doing your own research on, but one that might not be hitting your radar. So I'll leave you with that today. You can go do your research. You can send us a message and we can talk more about it. But really, take a self-assessment of your first half of 2022. Think about how it's going. Think about where you're going. And remember that things are going to get better, even though we had the worst half of the year from 1970. Things are going to get better. Think about how many shares you're going to build, how many you're going to buy, how you're going to, make your portfolio stronger. Think about the watch list of companies you want to invest in, and, dip your toe in the water. It'll be okay. So I hope this is helpful. I appreciate you listening. I hope you have a great 4th of July weekend, and I'll see you next time.